Hello, investors. Welcome to the monthly interaction. It's been an interesting time for equity market, both globally and domestically. Let us take them one by one and delve into some of the aspects that we generally discuss. There are four aspects that we will touch upon. First would be the global macro, and incrementally, if there is any event which is worth discussing. Second would be the domestic macro. Third would be the earnings, how the earnings are playing out, how the corporate events are playing out. And lastly, we'll discuss valuation and view. Those are the four aspects that we will discuss. Let us start with the global events. As we discussed in previous interactions, clearly the data point in US in terms of inflation as well as unemployment, as well as now incrementally growth, have surely and steadily started indicating that we are going to get interest rate cuts at some point in time. Inflation is gradually coming under control. Core CPI has come down to a level where clearly comment from Fed chairman has been that we will at some point in time experience interest rate cuts now. Our take has been very simple, that liquidity, growth and inflation comes in that order and it goes out in that order. You are at a stage where uh, uh, the inflation has started receding across the board, and while it has started slowly, it will actually gather the pace, and to that extent, we will get interest rate cuts anywhere between 50 to 100 basis point over next 12 months. That's the view on the US interest rates. It clearly has an implication for emerging markets in terms of reduction in cost of capital. As the interest rates get cut in US, we expect that even in India, the interest rates will get cut because we don't have any inflation challenge as such. That's the one aspect. The second aspect is Japan increasing interest rates and its impact on the yen carry trade. It as we indicated last month, in our eyes, it is more technical. And it will gradually reverse and not reverse in the fashion the way market is expecting. And to that extent, market has actually come back from the bottoms that were formed when we actually interacted last month. Market has come back anywhere between 10 to 20% depending on the market that you're talking about during this period. Also, the central bank in Japan has indicated that probably they might not increase the interest rate to an extent which market was fearing of. That's second. And lastly, how geopolitics is playing out. I think it continues to remain a aspect which we worry about. It continues to remain an aspect which has a possibility of actually creating any form of energy price risk, given that it is happening predominantly in the Middle East. So those are the three aspects. Broadly, the key takeaway for the global from global perspective are globally the interest rates, particularly in US, are set to go down, and we will follow the same. Having said that, when the interest rates get cut, you also get basically growth slowdown, which market, in our view, is underestimating. As you get inflation down, which also implies that growth will also get moderated. So from that perspective, export growth are likely to remain range bound. Third, as the cost of capital falls globally, it has a negative correlation with the large institutional investors in terms of how they think about the emerging markets. And to that extent, we expect that as the cost of capital goes down, they'll start looking at emerging markets. And if we hold our earnings growth steady, probably we will also be beneficiary of that at some point in time. So those are some of the key aspects on global side. Coming to domestic side, the only incremental data point for last month has been the first quarter GDP growth rates, which has come at 6.7, which was a little lower than what some of the market participants were expecting. But nonetheless, it was predominantly because of the heat wave and the election. And to that extent, we don't see a change in the 7% GDP growth rate or 7.2% GDP, 7 to 7.2% GDP growth rate that is been built by the consensus. One key takeaway from the GDP data point was clearly that the private consumption gradually and slowly has started actually reverting to mean, which was subdued. Predominantly, if you look at last 4 quarters, the earnings as well as the GDP was predominantly driven by government capex and capex formation. Now you are starting to see some private consumption picking up, as well as the private capex is holding on well. Those are the one or two key takeaways from the internals of the GDP data point. Rest of the macro data points remain healthy. Inflation is in check, although it is too low because of base effect, so it will increase to some degree, but it remains in check. The external factors on current account deficit side remain in check. The growth remains healthy. So most of the macro data points remain healthy. But as we have been discussing, and we have alluded to these things in last few conversations, that while the balance sheets are good, the macro stability is good. Income growth is something that has moderated over last few years, except for the premium part of the economy or government capex. But rest of the places, the income statement is a little bit of a challenge. Given this, what we are experiencing is that volume growth in the economy has been actually been subdued over last 6 quarters. While the earnings growth has been very strong, the volume growth has been generally been subdued. So as far as coming back to the macro, most of the domestic macro indicators remain good. The best thing, as we have been repeating virtually every conversation, is that the balance sheets remain extremely in good shape. The income statements is what is a challenge. Our sense is that the public capex, which is government capex, which was very strong over last 3-4 years, will translate into private capex, then the full-fledged real estate cycle, and then the consumption cycle. That's typically how the economic cycle works. So we are still the O3 in terms of direction, that you will get into a private capex cycle, you will get into a full-fledged real estate cycle eventually, which will create job and lead to a full-fledged consumption cycle. So you are somewhere in the middle of the cycle. So we are not worried about the direction of the business cycle and earnings cycle. Yes, having said that, there seems like an intermittent moderation in the earnings growth for financial year 25, and we'll come to that in the next segment, which is the earnings growth, how the earnings growth has played out. So when you look at the first quarter, the earnings growth clearly has been far more subdued. While part of it was anticipated, but part of it, which was downgrades to earnings versus the upgrades in the earnings, there have been more downgrades than the upgrades in the earnings. Earnings growth for Nifty for the quarter that has gone by, first quarter, because all the quarterly results are out now, has been about 5-6%, 7% earnings growth. And even if you exclude the oil marketing companies or oil and gas and metals, it still is around 10-11% earnings growth on YoY basis, which is a sizable moderation from last year. Financial year 24, we had an earnings growth of 24-25% in Nifty, and we had an earnings growth of upwards of 20-30% in the mid cap, small cap space. That earnings growth is set to moderate in financial year 25 to anywhere between 10-15%, depending on the market part that you are looking at, whether it is large cap, mid cap, small cap. And this moderation predominantly is, in our view, is because there is a lack of margin expansion which was available last year. As I alluded in macro piece, the income statement for the households have been slow, and it has reflected in the volume growth of the corporates. The volume growth for last year for BSE 500 was just 9%. This year also volume growth is likely to be 9-11%. And given that volume growth, if margin expansion is absent, then you are unlikely to get the kind of earnings growth you got last year. To summarize, we think that structurally all balance sheets are likely to expand, and it is also the consensus. But having said that, within that, financial year 25 looks like a year of consolidation where the earnings growth will moderate. So that's the earnings piece, where predominantly earnings are resilient. Earnings are resilient in auto, earnings are resilient in industrials, earnings are resilient in non-banking part of the financial services, which is market infrastructure plays, insurance companies, asset management companies, wealth companies, all these places. Then earnings are healthy in telecom, earnings are healthy in aviation, earnings are healthy in the real estate, earnings are healthy in still from a structural perspective in hotels. So earnings are fairly healthy in pharma. Pharma has been one defensive space where the earnings growth across the board is good. So those are the spaces where the earnings are healthy. Still, the global cyclicals, which is IT, chemicals, within domestic part, banks, cement, which is lenders, cement, oil marketing companies, commodities. These are the spaces where the earnings are still subdued. Having said this, there is a general view that largely the earnings in the consumption basket and IT basket has bottomed, and to that extent, given the under ownership that these spaces have experienced over the last 3 years, given the pain that some of these spaces have experienced over last 1 to 3 years, the valuations optically, while they look high, there is a hope that earnings upgrade cycle will start. To summarize the earnings piece, it's an interesting juncture where the domestic cyclicals have very strong earnings growth, but the valuations are little rich. But at the same time, you have spaces which are IT or chemical, which are global cyclicals, or domestic consumption, which is the FMCG, consumer durable, and the other consumption spaces, where the valuations from a historical perspective are in the fair zone, but the earnings upgrade cycle is still ahead, and that's where the portfolios are. So, from our perspective, also the portfolios are overweight on some of the domestic cyclicals, but at the same time, gradually actually trying to see which of these non-domestic cyclicals, which is basically FMCG, IT, predominantly these two large sectors, where the earnings are getting upgraded, and at the pace at which the earnings are getting upgraded, the portfolios are at the margin moving there. So that's the place to summarize. From portfolio perspective, portfolios are overweight on non-lending financial institutions, which is NBFCs, insurance, market infrastructure plays. The portfolios are still overweight on auto. Portfolios are overweight on aviation, telecom, pharma, industrials. These are the places in the where the portfolios are overweight on. Portfolios are equal weight on IT, FMCG largely, and portfolios are predominantly underweight on energy commodities spaces. So that's how the portfolios are positioned. Lastly, coming to the valuation, as we have been alluding to for some time, the valuations are rich in the context of incremental earnings growth. The one key clearly observation on the earnings is your earnings dispersion or deviation between large cap, mid cap, small cap is likely to kind of go down, which means the earnings for mid cap, large cap, small cap are largely likely to be in a tighter band as compared to past years, or past year particularly financial year 24. The valuations are relatively more attractive for large cap as compared to mid cap and small cap, and to that extent, even if it is a basically a next 3 year cycle, we see more valuation come for margin of safety in the large caps, and then selectively in the spaces which have underperformed in mid cap and small cap over last 2-3 years. So that's how we are looking at these spaces. For mid cap, small cap, the valuations are clearly at a valuation where the delivery expectation on earnings is fairly high. And lastly, coming to the statistical valuations, the Nifty is trading at something like 21 time financial year 26 earnings, which is also 10 to 15% or 20% higher than the historical valuations. Whereas as you go into mid cap, small cap, they are trading at anywhere between 26-27 times to 30-32 times of the financial year 26 earnings, which is at least 20-30-40% higher than the historical valuation. So they are clearly rich in terms of valuation based on the consensus number. This is largely we have to debate from last month on Indian equities. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.